Okay, up to now we talked about the different types of things you can invest in, but we really haven't said how you should invest. Which one of these is better and how much should I put in each? What should my asset allocation be? And that's what we're going to discuss today in this video. And really your asset allocation depends upon why you're saving your money. Why are you investing? What do you plan to do with your money? So let's talk about that. Let's take a look at each of these four cases. Suppose you want to preserve your money. You want to make sure that it can't go down. You put $100 in, you want to get $100 back. What does that sound like? Oh, that's cash, right? That's cash. Cash does not go down in nominal value. So if you need to preserve your money, absolutely have to, cash investments are the right place to put your money. CDs, money market funds, treasury bills. The downside is they're not probably going to keep up with inflation, and they're not going to grow. Right? But the upside is you're going to have the money. Well, let's suppose instead what you want to do is you want to maximize your investment growth. You're young. Most of you listening to this are relatively young. You got a long time, maybe some of this money you're not going to need. You want to keep it for retirement. You don't want to work forever. Let's start saving some money. Well, if you want to make your money grow, which asset class would be the best for that? Well, if you remember from last time, we talked about equities. Equities have, over a long period of time, the highest growth rate. It doesn't mean they're not going to go down, but maybe they go down this year a lot. Well, they did earlier this year, right? Stock market tanked, and it came back up. Stock market went down in 2008. It's hit records since then. So if you have a long time horizon, you want your money to grow, equities is a good thing. What if you want money available for emergencies? You get laid off, or there's an accident, or things break around the house. Well, in those kinds of cases, you have to have some money. That's probably, again, good for cash. Well, what about your parents, your grandparents? They saved money for a long time, and now they want money. They want to use that money to live off of. What would give them money? Well, bonds, fixed income, right? People who retire, they also talk about widows and orphans. People who aren't working but need some source of income. Well, fixed income is a good source for that. So how you allocate your investments, your asset allocation, starts with what's your objective? What are you trying to do with your money? Now, remember, asset allocation is the percent of your money you put in each asset class. We just talked about the risk you're willing to take. Some people aren't, even though they got a long-term investment horizon, they may not want to take a risk. Okay, that's a very personal decision. And it depends upon if you're going to need the money now, need it later, or you need income. A rule of thumb. Now, this is not a law of physics. It's not a have to do this. This is not, Klinger said this is the only way to do it. This is a rule of thumb. This is what general investment advisors tell people about how to do your asset allocation. First of all, and I think every financial advisor I've ever seen starts this way. Cash, the money you should put in cash, should be equal to about 3 to 6 months of expenses. Sometimes you hear people say 6, sometimes it's 3. But you want to save money for emergencies. So you start, even before you start thinking about investing, build up a cash amount. Right? Put that in a money market fund, put it in CDs, hang on to that money. Then, if you got money that you can invest, the percent of equities, the amount of money that you put in the stocks, stocks, the percent that you put in stocks, you'll hear a recommendation of 100 minus your age. So if you're 20 years old, 100 minus 20 means 80% of your investments should be in equities. I say should. It's a rule of thumb. If you don't want to take that much risk, don't take that much risk. If you want to take more risk, okay. But understand that in either case, why you're doing it. We talk about people willing to take more risk. Yeah, everybody likes to take risk until they lose money. Then it really hurts. Some people, when the stock market goes up, everybody wants to take a risk. When it goes down, that's when people start crying like little babies because they're losing money. But anyway, this is a rule of thumb. It's a guideline. You should pick your own based upon your investment objectives and your risk. Now notice how this works too. I said 80% would be in equities if you're 20 years old. If you're 80 years old, you'd have 20% in equities. Why? Less risk. When you're 20, you can recover from the market going down. When you're 80, you don't have as much time for the market to recover. So percent of equities is 100 minus your age. And then in case you're wondering, the percent in fixed income is equal to your age. So even if you're young, it's a good idea to have some in fixed income. How do you buy and sell? Well, you go through a brokerage firm. There's Vanguard, Fidelity, Schwab. Online, there's E-Trade, TD Ameritrade. There, you can go through banks. Merrill Lynch for Bank of America. PNC will do it. But you go through a broker. Why? Because they help find the other person on the other end of the deal. You want to sell, they got to find people to buy. You want to buy, they got to find people to sell. Now, when you go buy or sell, there's two ways to buy or sell. One is called a market order. A market order says, I want to sell now or buy now at the best price that you can get me. And that's the value of traders. Traders try to match people up. If somebody in Seattle wants to buy and you want to sell, how do you find each other? It's what stock traders do. So a market order says, get the best price you can right now. Because the prices change all the time. Right? Prices are changing every fraction of a second. It says, go out there, buy it right now at the best price you can get me. Or sell at the best price you can. A limit order is a little different. A limit order says, I will buy, but I'm not going to pay more than a certain amount. It limits how much you would pay. Or it limits how much you would sell it for. I want to sell it, but I'm not selling it for less than $20. Those would be a limit order. You should know these two. And then, kind of fun terms. You want to know, how's the market doing? We'll get into that a little bit more. Well, if the stock market is up, we call it a bull market. There's the big bronze bull down on Wall Street. If the market's doing well, we call it a bull market. The market's going down, we call it a bear market. Okay? And how do we know if it's a bear market or a bull market? How do we measure it? That's the subject of the next video.